Hello, welcome to another series of our finance literacy sessions. And today I want to consider a very important topic that I know most of us deal with almost on a daily basis. And so I want to consider the topic of bank overdrafts. Now, I know this is a facility that most businesses use almost on a monthly or a fortnight basis. But what is it? How does it impact our business? Do we need it? Must we have it? So a bank overdraft is a short-term financing tool that allows a company to withdraw money from its bank account that is available. Now, it's beneficial for managing working capital requirements for several reasons. So working capital is actually the difference between current assets and current liabilities. So if that difference gives you a zero, well, it means the company can just cover for its obligations. If it is positive, then, well, the company can cover for its obligations and to some extent be ready to adjust to some of the unforeseen eventualities. That is to take care of emergencies. Well, the agenda in this particular video: one, how bank overdrafts aid companies in managing working capital requirements. That's the first topic I'll be looking at. The second one is key indicators to monitor when using a bank overdraft to manage working capital. So one reason that I mentioned in the previous, I said how bank overdrafts aid companies in managing working capital requirements. So that's the first that I want to consider. Then I'll finalize by giving the key indicators that one needs to monitor if at all you are making use of this facility to ensure that your day-to-day operations move on smoothly. So one reason how they aid is flexibility in cash flow management. Now, overdrafts provide immediate access to additional funds. This makes it ideal for companies that have large fluctuations in their bank balances, because owing to the nature of business, you cannot compare, say, a company dealing in say foodstuffs and say a company that is selling camera. The flow of cash for that those particular two companies will be different. But it does not mean that those selling cameras are not making money. Yes, they do. It comes once in a while, and it comes huge once in a while, but it does not flow in daily. So this flexibility is useful in meeting short-term expenses such as paying suppliers, salaries, and other operational costs without disrupting daily operations as you wait for your huge money to check. Now, it may not be coming in daily, but it comes in pattern, in some maybe in a predictable way. But then one should bear in mind that there are some daily operations that must be taken care of so that the company is not seen not to be in business. Second reason why or how it aids companies, it is cost-effective short-term funding. Now, compared to longer-term loans, bank overdrafts are generally more cost-effective for short-term financing. I think let's get the difference. There's a difference between saying cost-effective and saying not expensive. So here we are saying are generally more cost-effective for short-term financing. The interest charged on overdrafts reflects the convenience that is being offered, as interest is only paid on the amount borrowed and for the period it's in use. Mostly interest, overdrafts mostly will be given for a period of, say, a month. It can be for businesses that banks have known how they have studied the patterns of their cash inflows. It may be weekly or fortnightly. It depends on the arrangement. But in any case, the interest charged on overdraft reflects the convenience that is being offered as interest. As interest is only paid on the amount borrowed and for the period it's in use. Now, this reduces the overall cost of borrowing, making it an economical option for managing immediate cash needs. And again, when one is accessing overdrafts, there are no much requirements like a lot of guarantees that are needed, no much collateral. that will be needed when you are accessing this particular facility, and paperwork may be fast enough to meet the needs for the cash. There's no fixed repayment schedule. Now, long-term loans have a fixed repayment period. You may be given a grace period, but after the grace period, deductions will start, and such deductions normally are timed on a particular date of every month. Failure to pay that money on the agreed date, that attracts charges. So with this, with overdrafts, we don't have such fixed repayment schedule, and this is useful for companies with fluctuating cash flows, allowing them to repay their overdraft as and when surplus cash becomes available. It also improves working capital efficiency. Since you see, by bridging the gap between cash inflows and outflows, if you are not able to pay for other resources that you engage on a daily basis, because it's the resources that you engage that will give you the output. Now, if you are not able to employ them fully, optimally in a day because you lack cash to engage them, then again, efficiency of all that goes on in your business is something to worry about. So by accessing this facility, overdrafts enable companies to optimize their working capital. This can help prevent delays in important payments, improve credit terms with suppliers, and even support customer relationships by ensuring timely deliveries. It's also supporting business growth. Now, for seasonal or growth focused businesses, overdrafts allow for the smooth management of increased working capital needs during peak periods. Now, this helps in meeting customer demand without requiring permanent capital outlays. Now, consider the hotel industry. Mostly the hotel industries in particular areas or particular regions will depend on seasons. Now, there are seasons when the sales hit the ceiling, and there are seasons, and mostly again, this particular industry is also affected by political factors. It's also affected by natural factors, and to some extent, economic factors. So when this particular when a firm in this particular industry or a company needs to respond to change in demand, whether high or low, change in demand necessitates change in or adjusting the factors of production so that you get actually the input, so that you get the right output. Now, by doing that, if you can take advantage of overdraft facility, you are able to even reach out to lease that particular equipment or resource that you need for that particular purpose without having to actually spend a lot of money in terms of acquisition, because you may acquire it, but at the end of that peak period, it may lie idle waiting for another time when the demand hits and it's relevant to the needs. Now, next, we need to consider challenges with overdrafts. As much as we have talked good things about it, there must be other downsides or bad sides of overdrafts. Now, overdraft is repayable on demand. If the bank becomes nervous about the management of the account, then it can withdraw the loan, forcing the company to find funds from alternative sources at a time that is likely to be very difficult. Now, there may be an overdraft facility charge that is charged by the bank for offering the overdraft, and this is paid whether the overdraft is used or not. So we know that there are businesses that know actually the pattern with which their cash flows in. For instance, you may be in need of cash immediately now, when you know very well that in 2 days' time you will be receiving your money. Now, in this case, you'll be going for this kind of facility. That charge will be levied on you, but then you know that you'll be paying, say, after 2 days. So we are saying that in that sense, it's much of a burden to one who does not intend to count the full days that the interest is based on. Then the second bit, I said that I'll also consider if at all you are in business and taking advantage of this facility so that you keep afloat on a daily basis, then there are also key indicators that you need to watch so that you don't end up enjoying the overdraft to an extent that it is your lifeline or it is the lifeline of the company. If it becomes the lifeline of the company, then that is a bad indication for the future health of that particular business. So when using a bank overdraft to manage working capital, here are key indicators that provide insight into companies' financial health and help avoid excessive reliance on the facility. So cash flow, first thing you need to keep your eye on is regularly monitor cash inflows and outflows to assess whether the company's cash position is improving or deteriorating. A strong positive cash flow indicates the company can quickly repay the overdraft, while negative or inconsistent cash flow may signal an over-reliance on the overdraft. But you see, there are consequences on over-reliance of the overdraft, since you may end up working to pay the interest charged by overdraft. So it affects the profit margin. The fact that a business over-relies on overdrafts risks or reduces the profit margin. Overdraft utilization rate. Kindly track how much of the overdraft limit is being utilized over time. A consistently high utilization rate suggests that the company might be too dependent on the overdraft for daily operations, indicating a potential need for alternative or additional financing sources for the company or the business. Interest costs. Another thing to watch is the interest cost. Since interest on overdrafts is generally higher than on long-term loans. So this is why I say there's a difference between cost-effective and expensive. So since interest on overdrafts is generally higher than on long-term loans and accrues daily, monitoring this cost is vital. And rising interest expenses due to prolonged use of the overdraft can erode profits and signal cash flow strain for the business. And that's a bad indication. So there is need, because actually that overdraft is not free. You are buying it at this cost, and the cost is the interest. That is the cost. Among other costs, that is one of the costs of that overdraft. So the overdraft is not free. Debt turnover ratios. These ratios, like the accounts payable turnover and accounts receivable turnover help gauge how efficient the company is managing short-term debts and collecting receivables. Low turnover ratios might indicate delays in customer payments or extended supplier credit terms, which can increase reliance on the overdraft. So a low turnover ratio, that is not so desired. So it should be kept at a reasonable level that is agreed upon as the capacity of the company or as the standards require. Working capital cycle. This cycle measures the time it takes to convert inventory into cash. Well, you took the overdraft and gauged it in terms of buying some merchandise that you intend to resell. So the question is, what is the time taken to convert inventory into cash? A longer working capital cycle could mean slower cash conversion, leading to extended overdraft use. Analyzing this cycle can help determine if adjustments in inventory or payment terms could reduce overdraft dependency. Liquidity ratios. Ratios like the current ratio and quick ratio provide an overall view of the company's ability to cover short-term obligations without solely relying on the overdraft. Now, declining liquidity ratios indicate financial strain and can highlight a need to improve cash management. Seasonal trends and overdraft peaks. Now, in businesses with seasonal cash flows, monitoring the timing and amount of peak overdraft usage is crucial. This can inform budgeting and help the company avoid excessive borrowing during low revenue periods. So what we are saying, you should only use this overdraft when you need it. If you need to expand the scale of your operations as you respond to market demand, then that is so. But in between, when your sales or your revenues are not at their highest, then it's not advisable. But again, your revenue will be high if you are selling more, and selling more means you are responding to the demand. So when there is no such need, there is no need to rush for overdrafts. Overdraft fees and compliance. Banks may charge additional fees if the overdraft exceeds its limit or remains in use for extended periods. Keeping track of these fees and staying within agreed upon terms can help control costs and avoid penalties. And in fact, these overdrafts are very expensive if you fail to honor the agreement, the spirit and letter of the agreement. So it may become a burden if not clearly watched. Conclusion: monitoring these indicators enables proactive management of the overdraft, helping the company maintain a healthy balance between short-term liquidity needs and long-term financial stability. To ensure that the overdraft is being used effectively and sustainably, here are the main indicators, as we had said. So these I've discussed, and it's just a way of, if you look here, assess how often the overdraft is utilized, that we have considered. Keep an eye on external economic factors that could affect cash flow, such as market demand, economic downturns, or changes in supplier pricing that we have covered in a way or another. So this will help you manage your working capital effectively while using a bank overdraft. Now, it will also help you minimize the financial risks and ensure that the business is sustainable. So if this was useful to you, remember this has come from Mathematics, Economics, and Finance Online School. Here we empower minds. We also help you master numbers and shape finance and economics future. Thank you, and follow me through my next video.